So again, this whatever we are discussing is how to select stocks based on some criteria, and this is a part of the WealthCon. And pranams to sir, Dr. Ramnath. He has actually converted many of the ignorant doctors into income generating doctors as far as the finance is concerned. So you need to go through this course, especially those who are not got involved with the other aspects of money management. So it's more important that we learn about the money management. The first thing is to set up your own Demat account. Before you do anything else, first go and do your own Demat account. Most of the times now it is online KYC. You don't have to fill forms. You just have to do, and online verification is happening in most of these brokers. So understand the terms of the user interface, how to place an order, how to buy a stock. Take guidance from a friend who has done it before, because this is overwhelming. When I started just after the COVID time. I also got into the market. Previously, somebody else was managing. Then we had a loss. Then we couldn't contact him for the losses when the losses happened. So choices of stocks are there according to what they would have bought. So when you are investing through PMS, there are a lot of things that happens. There is something called as a front running. So they are the fund managers. Even big fund managers are involved. You must have heard about some of the mutual funds managers who were caught front running. Front running is you have a stock, they will buy the stock first. Then when you are investing money into the mutual fund, they will start buying the stock. So they would have bought at 10 rupees, and then they'll use your money to increase the price to 20 rupees. And when it comes to 20 rupees, they'll sell off their investment, and you are stuck there. So somebody who entered the mutual fund would also have bought that stock at 20 rupees. So he is stuck with the loss. After that, the market goes down, he is stuck with the loss. So front running happens in majority of them. But as retail investors, we cannot predict when it is happening, how it is happening, but we need to be aware of these terminologies at least. How to select a good using what is called as an MPTDS criteria. This is what, to make it simpler, see basically why Ramnath sir has done all these things, is Ram sir, is to simplify the things so that doctors themselves start doing it for take care of their financial journey. So most of the times, retail investors fall prey to tips trading, follow blindly some financial guru without understanding. So as I said, to initiate and encourage ourselves to start learning about doing stock selection of our own, and how to do fundamental analysis. There are two things whenever you are buying a stock. One is called as a fundamental analysis, other is called as a technical analysis. So what we are talking now is the fundamental analysis, not the technical analysis. Technical analysis, you are trying to time the market, seeing what is called as a support zone, what is called as a resistance zone, and you buy when it is at the lower level, that is a support zone. And you want to make a profit, you have to sell it near the resistance zone. So those things all will be taught in the trade vesting courses that will be done. But to begin with, so if you want to have a long-term portfolio, this is MPTDS, whatever we are saying is for large caps. So you again, your criteria you have is you have stocks which are called as banking and non-banking now. Again, in non-banking stocks, you can have dividend paying and dividend non-paying. So these are the various types of stocks that you have. For the dividend paying stocks, you use what is called as a MPTDS criteria. For the dividend non-paying stocks, you use what is called as a MD Sport criteria. So MD Sport, each one M, everything stands for a particular term. For banking, we use what is called as a MG Sport. Okay, these are the terminologies that are used. So why it is required, as we told you, we are looking at selection of fundamentally strong companies. It's a passive investment. You can also do active investment or trading because these are safer companies to trade. Then you can do SIP buying or dip buying, as Dr. Nikhil was telling. And minimum duration is to have and hold these stocks for longer duration, not for shorter duration. This is again important if you want to create long-term wealth. So this is the criteria that have been put up. One is the market capitalization. So market capitalization is how much is the total number of stocks of that company into the current price of the company, stock price of that company. So that will give you the market capitalization. So choose companies which have a market capitalization above 10,000 crores. Then the price of that stock from its start, when it started till now, it should be in an uptrending phase. It should be going up and up. Its tax that it is paying to the government should also be increasing year on year. That means to say that this company is making profits, hence it is able to pay tax to the government. So the tax also that the company is paying should be increasing over the last 10 years at least. Dividend that the company is paying should be increasing, and the sales should be increasing. See, so he has put minimum things here. There are a lot of things which are there, but these are the minimum things that they have put up. How to assess? You can use the website called as screener.in, and you can type in these criteria. So as we told you, so if you chart this graph for the last 10 years of TCS, you can see that the price has been increasing. Although you see that it has gone up, down, gone up and down, gone up and down. But if you join from 2014 to 2024, the chart has actually gone up over a period of time. Although it has come down, come up, come down, come up. So this is how you should want the chart to be over a period of time. If you see this another stock, which is called as ONGC, you can see that it has not gone anywhere for the last 10 years. It started at 300 or 250, and it is remaining at the same price over a period of time. So this is the thing that you don't want to choose. So it's not uptrending as far as the price is concerned. Although the market capitalization is more than 10,000 crores, but the stock price has not increased. Limitations, most of these companies are mature or at a steady level of growth. You may have relatively lesser income or returns in this, but you will have safer returns. So low risk, low returns. But you can add diversification. You can add some higher growth companies also to this, okay? So for that, you can choose what is called as the MD Sport. So here, we are talking about companies again with more than 10,000 crores. Your debt to equity should be less. So make sure that you understand these terms, debt to equity. So how much the company has taken loan to run this business versus how much is it worth in the market. So if it should be less than 0.3, that means they should have taken, if their equity is worth 1 rupee, they should have taken more than 30 paisa of debt. That is what it means. Then we need to look at the operating margin. Then there is something called as an ROCE, that is return on capital employed. How much capital they have used and how much they have got back. So select which has got more than 20% is the best. Again, you may have to reduce or increase these numbers depending on what stocks that come out of the screening. Then the sales growth, then profit after tax, and tax that is paid. So these are the things that will be taken care in the MD Sport criteria. As far as the growth of the this is the criteria that we use, more than 15%, and return on capital employed more than 20%. So using this, then we screen the companies. So there are various parameters, I think operating profit margin, there are many terms. So once you get into the financial learning journey, so you will all be learning these terminologies one by one. Otherwise, it is very overwhelming. It takes a lot of time to understand these terminologies. So we have given a score. This has to be done on a, Excel sheet. And once you have a total score that is more than 75, these are called as valid stocks. If it is less than 50, these are called as invalid stocks. So you have to score them based on this, and you will have a watch list of forward. If it is between 50 to 75, then you put them in the watch list, and then see if they're performing well, and then you can enter the criteria. So the main aim is to standardize the selection criteria using a scoring system to eliminate the risk of averaging due to inconsistent and volatile numbers. Sometimes, like when you have a COVID, or now you had a market crash or a Trump effect, now suddenly because of this volatility, their sales may suddenly dip now. So to take into consideration, you have to take for a longer period of time and then average it out and then score them. So if you score them based on this, so you'll be able to select good quality stocks. Now, banking related are used a different criteria. This is called as a NG Sport, wherein there is something called as a gross non-performing asset. So this is to be used. So many banks, as you know, would have given loans, and after taking the loans, the person who took the loans vanishes off to another country. So that loan becomes a non-performing asset. So they should have the least amount of non-performing asset. So this is the screener website that is there. So you have to use the screener website and put the whatever criteria that we told you. So this is a video that will show you how to do this. So when we put a criteria, say here, the first criteria we put was market capitalization more than 10,000 crores. So when you did this, you see that approximately, sorry. So you saw around 451 companies came up when you just put only one criteria. Okay. So then you change it to the criteria that is required. Now we have put all the criteria now. So how to do it? You have to do it market capitalization more than 10,000, then and has to be used. Then you have to put all these things, whatever is required. Then you should run this query. So you can use this. It is free. This is all free on the website there. And then once you run this query here, then you got just 18 stocks now. Just 18 stocks. Now again go back and see all of them, and then see for each of them you have to select and do the calculations for all of them, profit, loss, and whatever is there, and then put them into Excel and do the charting. Okay. So you have to do this based on whatever is there. You have to download all. So some work is required to do these things, but if you learn to do it yourself, then you will be able to select the stocks for yourself. So then the charts are there that will show you how the performance has been. So you can compare various charts of various companies and then make a list of about 5 to 10 companies that you want to invest in over a period of time. Okay. So for passive investors, as we told you, you can just invest in these what are called as Bs, Nifty Bs, Junior Bs, Mid 150, Gold Bs, Bank Bs, Junior Bs. So if you don't want to do all these things, so you can just think of buying these through the Demat account. So again, we are told about dip buying. So whenever the market is coming down, have some money in your bank to invest it so that it will give you a better return over a period of time, and have it and hold it for long term. Okay. So as we told, you need to diversify your portfolio. Then only the overall CAGR will increase. Good selection of 20 to 30 stocks can be done. So it's important that we become self-reliant to achieve the financial freedom. Thank you.
Thank you, Raju, for this nice talk. And ultimately, the aim of this instruction course is to just make you aware that we as doctors should not be befooled by these agents. We should take this thing, finance, into our own hand. Ultimate aim is to become financially independent and to become Atmanirbhar. And if we can do it, you can do it. Okay? So start it from today. And thank you for taking out time on a Sunday morning, last day of the conference. And we really appreciate your presence. Thank you. Thank you.
Thank you, audience. Thank you for being here.
Maybe